Just a heads up, so this is a bit more of an advanced meeting compared to what we did previously, which was mutual funds and you know, rah for investing. There's going to be a little bit of math here. It's a little bit more advanced. I don't mean to scare you off. I'm just telling you that for stock analysis, the way I do it, it's a bit more technical. The other thing is, this is all going to be my approach to stock evaluation. And investing in individual stocks. I go to several investing meetings, and everybody has their own theory, and it's great to learn from other people. Some people read, you know, the annual disclosures and just do a lot of investigation. Other people just sort of like the story of the stock, like Tesla, great. It's electric cars, what's not to like? And they invest in it. So everybody has their own approach. So this is my approach. All right, so overview. So seminar goals, caveats, and warnings. So I'm going to be describing specific things that I look for when I'm investing in individual stocks. Questions and discussions are welcome. Please do your own research and reading about the various topics prior to investing. The 2-hour seminar gives you just enough to be dangerous. Obviously, it doesn't get you ready to go be a broker on Wall Street or trader on Wall Street. Disclaimer. Yeah. Disclaimer, I'm not a certified financial planner. I can't sell you any financial products. This is not investment advice, and it's for educational, entertainment, and demonstration purposes only. It is not a solicitation to buy or sell any securities. All of this is my opinion, as I have said previously. Beating the market is very difficult and requires time and research, and even experts can't do it consistently. There was one book about stocks that I read, and the first thing they said was, just if you don't want the excitement and you don't want to do the research, just buy an index fund or an ETF that covers the market, and you're likely to do as well, if not better, than picking individual stocks. Having said that, all of us try to do it. So here we go. So just a quick background, what an IPO and public offering actually means, and when somebody says going public. And it's also how people get rich. So you get a private company that needs more money to expand their business. So they go to an investment bank to go public. The investment bank reaches out to all of their investor friends and says, how much is this company worth? Based on the paper that the company gives them. The friends value the company at, let's say, I'm making an example here, 15 million based on the available info. They decide to put out about 1 million shares. So technically each share is worth 15 bucks, but the investment bank is going to give the company $10 per share, but the investment bank is actually buying those shares and is giving the company money. And after that, the company is out of it. It's now the investment bank. Now, so yeah, the value is assets plus liabilities plus future expected earnings. That's kind of built into that 15 million valuation. So when there's an IPO for a good company, the investment bank will sell those shares privately to their investment friends and to rich investors, I would suppose. But they'll sell them for 12 bucks a share. So they're making $2 a share. So they're making, in this example, $2 million. This example is extremely low, by the way. I don't think anybody goes public and gets a 15 million valuation. So the investment bank makes a profit that way, and now what is left will now be sold on a stock exchange, and of course the owners who bought it privately can now go to the stock exchange. Basically, if you get any pre-IPO shares available to you, they're usually not worth having. So searching for pre-public market shares generally is not the thing to do. because if it was a good investment and everybody sort of knows what it is, those shares are gone and people already have them, and then they'll sell them to you, but at a premium. Anyways, once the shares are available on a stock exchange, which is actually the secondary market, the public will initially be buying any remaining shares from the investment bank, and after a few hours or days, all the trading is between investors. Like when you invest your money in an individual stock, you are not giving that money to the company most of the time, vast majority of the time. Sometimes the company has some shares left over that they've kept, and then they might go and sell those, but you're not giving that money to the company. So this isn't really practical, but just so you know what actually happens when you do an IPO, that there's an investment bank involved, they take the risk, and then they obviously make a profit. Okay, some accounting. So here's maybe where if you took accounting in high school or in college, it'll come in handy. So what we need to know for our purposes is the balance sheet is where assets equals liabilities plus owner's equity. The name comes from balancing. So the assets you either got using debt or the money that the owner brought in. And so we'll be referring to the balance sheet later on. Balance sheet also has current assets versus current liabilities. So current assets is liquid things like cash or stuff that you can turn into cash fairly quickly. Current liabilities is stuff that is due within 90 days usually. So it's your creditors. But current liabilities wouldn't be like a mortgage on the factory or something like that. Income statement, income minus expenses equals earnings. The income is the top line, and earnings or profit, another word for earnings is profit, is the bottom line. That's where the expression comes from, give me the bottom line. Income is organic. The earnings can be manipulated by cutting the expenses. So we'll be looking at the income as well, because that's much harder to fiddle with than earnings, which you can temporarily improve earnings by cutting expenses, but there's usually a long-term cost by doing that. Earnings then can go to capital expenditures, meaning reinvesting into the company, and or dividends, which is money paid to the owners of the company, meaning you, the stockholders. Okay. Market capitalization, this isn't accounting, but I kind of threw it in here because it felt right. It's how much is a company worth, and how you do that is the number of shares that they have outstanding times the price per share. So in the previous example, if the company has $1 million outstanding, sorry, 1 million shares outstanding, and the shares are trading at $20 a piece, then the company's capitalization or worth is 20 million. And that we went over that in a previous seminar, but that kind of tells you whether the company's small or medium or large. Another thing I wanted to throw out there, because it's a frequent question, the share price doesn't matter. Whether you're talking about stocks, an ETF, or a mutual fund, if it has a price per share of 10, it doesn't mean it's any better than one that has a price of $5 a share. What matters is when you multiply through by the number of shares, that gives you the size. But just because a company is trading at $1,000 a share, that doesn't make it any better than a company that's trading at 50. A word about penny stocks, meaning the share price is less than $1. They're avoided by some mutual funds. So this is where the stock price sort of matters. And then if you have a margin account, a trading account where you can borrow part of your purchase, then margin accounts won't lend you money to buy penny stocks. So only here is where it matters if it's less than $1. Okay. Any questions on this? Everything sort of makes sense so far? Please feel free to speak up. This is for you guys. All right. So what we're going to be concentrating on during this seminar is fundamental stock analysis, meaning we look at the financial statements and health, its management, its competitive advantages, competitors, markets to determine its viabilities and future revenues and earnings. That's fundamental analysis, and that's what I largely use. There is something out there called technical analysis or charting, which is looking at charts, looking at statistics to determine, are we going to go up in stock price or down or what? So they do, they basically draw lines over these charts without really knowing what the company is. There's conclusions to be drawn about where the stock price is going. So it's a method of evaluating securities by analyzing the statistics, such as past price and volumes, and of course the graphics. They don't really look at the intrinsic, the underlying value of the company, but they just use charts like I showed here. So they have, for example, you have support lines, and you have lines of resistance, points of resistance where the stock goes up here, and then it bounces off of this line, and then it goes back down. If it ever goes through a resistance line, then that line also becomes a support line, and it's not my thing. There's enough people out there who use it for it to have credibility, and it's a totally different thing than what I'm going to talk about. They're mostly used in day trading, which is short-term trading where you purchase and sell in the same day. But some people also use it for longer-term investing. So a day trader, I'm sure you've heard, they will watch these things and a bunch of other parameters. And if the right sequence of parameters is all in place, they will buy, because that gives them, they believe, an 80% chance that the stock is going to go up. And then before the close of the market, they liquidate their position. That's the day trader. You'll also, there's also statistics like, you know, S&P 5, I made this one up. S&P 500 is up 56% of the time in November when a Democratic president is in the White House. So it's like people look at that, you know, the whole sell in May and go away expression, if you've heard that. That sort of comes from technical analysis. Other types of trading, short-term trading, are mentioned the day trading already. Swing trading and momentum trading are short-term, and they use technical and charting tools. Long-term trading can also use this, but usually long-term traders also incorporate fundamental analysis. So it's kind of cool. The problem is I'd rather invest the money and have it working for me rather than sit and watch a screen all day, and if the stars don't align, then do nothing. So that's kind of why I've taken a couple of courses about it, and I have sort of a vague understanding of it. But it's not really something that I want to pursue at this point. So this is the only mention of it. It's kind of cool. If you're a visually oriented person, why not? All right. So let's look at some stock ratios. So these are metrics regarding a company as far as share price and other performance. So I try to keep it to a minimum, basically the stuff that I look at. But there's a whole bunch of them out there, and if you do individual stock trading, you will kind of develop your own favorites by talking and listening with other people. So this is kind of the basic version. So earnings per share. So in my previous example, company has 1 million shares out. During a year, they make $2 million. So in profit, in earnings. So their earnings per share is $2, is $2 per share, right? 2 million divided by a million shares is 2. It's not really usable to compare company to company, but it's usable to compare one quarter of a company to another quarter for the same company, just to see how they're trending. And so analysts will make predictions about earnings per share. A company will report, and then they will either beat it, which means that the stock price will likely go up, or they'll miss it, and the stock price could very well go down. So it's the net earnings divided by the number of shares. So price to earnings, PE ratio, very common. There's so much analysis regarding this. So it comes from the income statement. Well, that's because that's where the earnings are. The price is price per share. So it's price per share divided by the net earnings per share. So it basically indicates the number of years it will take for the company to make back the money you paid for that share, right? Because, so example, the share price is $20 and their earnings per share is $5. So they earn $5 per year. So it will take you 4 years to make that money, to make your $20, for the company to make your $20 back. Just to be clear, we're talking about the profits of the company, not the dividends that you as an investor get. They don't have to give you any of the profits in dividends. So we're talking about the profits, the earnings here. So alternately, you can also look at it as the price I paid for $1 of profit. So if the price per share is 20, earnings is 5, PE is 4, 20 divided by 5. So I'm paying $4 for $1 of profit that the company makes on an annual basis. So this varies by sector. Typically, it's more than 10. It can be more than 100, the PE ratio for growth stocks. The S&P 500 averages kind of 13 to 15 bucks. Sorry, 13 to 15 for the PE ratio. Anything much higher probably means the market is overpriced. So a higher PE ratio reflects an investor belief that the sector has higher growth prospects, and the price reflects those future expected profits. The market is always forward-looking, so it's seeing, okay, I'm willing to pay for future profits, which will hopefully arrive. If they don't, the price drops. If the PE ratio is lower, then maybe the sector is experiencing lower growth, or there's something wrong. So for example, the Russian stock market has a PE ratio of 6. And that's because every so often, everything gets nationalized and all the investors lose their money. Hasn't happened to me, but it definitely has happened. And so people just aren't willing to pay as much as they are for US stocks, for example. But if the PE ratio starts hitting 20 for the S&P 500, people start going like, yeah, okay, it's looking a little frothy. And people are just willing to, people are optimistic, for example, and there's a lot of emotion involved in investing, which I'm going to try to talk you out of fairly soon. And so when people are feeling confident, they'll bid up the price. Remember, this is a ratio. You have price over earnings. So if earnings don't change, but the price is increasing, the PE ratio ends up increasing. And that's when people start asking why. Why are you willing to pay more for the same amount of earnings? Now, if the earnings go up, then the price will likely increase as well at the same time, so the PE ratio stays steady. Okay, so there's a lot of calculations and a lot of head scratching over the PE ratio. So very key metric. Price to book. And I'll, after I finish this page, I'll flip over and I'll show you these ratios in my Qtrade account. So price to book, it gets its information from the balance sheet. So it's the price per share divided by assets minus liabilities. So basically net assets that are attributed to a share. So it basically means how much am I paying for $1 of company's net assets, net being the assets minus liabilities. All right. So it also varies with sector, and I'll show you a very cool graphic in a sec. Sectors with a low price to book should theoretically be more attractive because then they're theoretically undervalued. So I think this is out of date, but the price to book of Canadian stocks on the average is 128, while over today it's 128, but it's rarely below 132. So it's indicating that the stocks are undervalued. A ratio of less than 1 would mean that if on paper, if the company were to go bankrupt today, your share after the other creditors, this is the less liabilities part, after the other creditors got their money, what would be left over, you would get more money per share than what you paid for it if the ratio is less than 1. If this isn't clear, I can explain that. But so that this is where the little bit of math comes in. All right. So here's the cool chart. So you've got price to book, or cool to me anyway. You've got price to book on this axis, and you've got price to earnings on this axis. And it shows by sector where this is healthcare up here and non-consumer goods and services. So technology, for example, is averaging a very high price to book. The PE ratio isn't huge. Financials, low price to book relative to other sectors, and the PE is probably 20 on the average for American financials. So when you get these statistics for your stock, it's good to compare it to their competitors and to the overall sectors and kind of see where they compare. Okay. All right, dividend yield. So a dividend payout is always in dollars per share over a year on an annual basis. So then you divide it by the price per share, and then so it gives you a percentage. Basically, what is the cash flow return on my investment? So how much of the dividend that it's paying, how much is it as a percentage of how much I am paying in order to get that dividend, meaning the price I paid for the shares. Obviously, when you have not obviously, you would think a higher dividend yield would be better, but because of the way it's calculated, if the price has tanked, has gone down, you suddenly get a dividend yield of 12-15%. So those you would want to be very aware of and careful with, because it could be that the company is in trouble, or it's very likely the company's in trouble. and that they will be cutting their dividend. In which case the stock price goes down further, or maybe not. But anyways, so this yield will change as the dividend is increased or cut, or if the share price changes. However, if you actually buy the stock, that locks in the yield. Obviously, as long as the dividend doesn't get cut. So again, it's a ratio of how much in dollars they're paying you a year in dividends and how much you paid. And so both of these can vary. If the price goes down and the dividend stays the same, then the yield will go up. If the price goes up, then the yield is going down. But if the price is going up, it probably means the company is doing fairly well, and they're likely increasing their dividend. So the yield might actually stay roughly the same. But it's all a proportion. It's all an equation. Okay. So yeah, if the company does well and dividend increases, so if I bought the stock and it was yielding 6%, and now the company does well, its price goes up, what I paid is locked in because that's what I paid. But if the company does well, it's likely that they will increase the dividend. So now your yield on the money that you invested is actually further improving. So if you pick the right company and they increase their dividends, you're golden. Okay.
Hey, Alice.
Yeah.
Is it okay if I quickly make a comment on price to book ratio?
Sure.
So just wanted to point out one thing about price to book ratio. I mean, this is the valuation metric that makes sense for companies that have tangible assets, such as banks and materials and industrials. I mean, I often invest in companies like technology and healthcare, for example. These companies don't have anything tangible. Everything they have, these are soft assets and they're proprietary. So their valuation tends to be really subjective. So if you're buying a technology or healthcare stock, for example, such as Microsoft, Google, Apple, or Shopify, uh, price to book value is not going to make any sense to you. And typically that hasn't been the valuation metric. Typically, these companies are valued based on their cash flow patterns and histories and their growth rate.
Yes. Yeah. So very good point. There's multiple things there. So let's see if I can go through some of them. So you'll note healthcare is up here. So their price to book is in the US is averaging 8 or 9, and technology looks like it's averaging about 7. And that's exactly right, because they don't necessarily need to have much in hard assets. Like technology companies, it's mostly proprietary. There might be a whole bunch of services there as well if it's a consulting company. So they make a bunch of money and their price is high just by not really having much in assets. But if you're looking at utilities, for example, they need to have, whether it's generation stations or phone lines or pipelines, whatever it is. I guess that would be more towards energy, but so they need to have a lot more assets, so their price to book is lower. So you would want to compare a technology firm that you're looking at buying to other technology firms, and not try to compare it to a bank down here for these ratios. So that's a very good point. Companies are valued on lots of things, and it's sort of mixed together. Everything from brand name recognition through to is their stock ticker, the 3 or 4 letters that represent the company. Is it user friendly? Like Budweiser uses Bud, BUD. That seems to have a certain amount of value with investors. which is funny, but it does. Also, what are the future prospects of the company, the cash flows that they make, the earnings that they make, and then people take them out 10 years and they they use the interest rate to lower the values of the future earnings and so on. So, like I said, a lot of people do a whole bunch of investigation and a whole bunch of calculation. So make sure you do that as well when you look at these. But yeah, make sure you're comparing apples to apples, and look at the overall sector as well. So that's a good point. Okay, let's do. There's a couple more ratios, and then I'll try to switch us back to my Q-Trade account, and we'll look at a stock. So the dividend payout ratio is an important metric. It's the dividend per share divided by the earnings per share. So it indicates how well the dividend is covered. So if you're buying a company for the dividend, which some of us are, this looks like, okay, they're paying out $4 a share per year in dividends. How much are they earning? Well, if they're earning $5 or $6 or $7 per share, 4 divided by 7, you're fine. That's not a problem. If they had a couple of bad quarters and they're earning $2 a share, then you have a problem with the dividend. So you want to keep that ratio to be around 40 to 60%. Otherwise, the dividend may not be sustainable. If it's over 100%, then it likely means the company is borrowing to pay the dividends, and this happens all the time. Now, a caveat here is that depreciation and amortization takes away from the profits, the earnings at the bottom, and so if you want, but it doesn't affect the company's ability to pay the dividends. So if you want a better picture, you would want to look at free cash flow to pay the dividends, and therefore you'd want to add the depreciation and amortization back in. So it requires looking at their financial statements and doing a little bit of math there as well. Okay, so debt to equity is basically liabilities divided by the owner's equity on the balance sheet. If it's a high ratio, it indicates that a company borrows a lot and finances its assets with debt rather than releasing more owner's equity, meaning more shares. So you'd want the company to preferably be less than 1, but it depends on the company. If it's a utility company, they likely have to borrow a whole bunch to get to get all the assets. Like I said, whether it's the wireless networks or whether it's the the hydro station or whatever it is. So then they have to borrow. So again, you have to compare apples to apples. But obviously, lower debt is better. You could also look what kind of debt they have, and if it was for infrastructure, then that's good debt. You could argue that to buy back shares if they borrowed, that's bad debt because it didn't really add anything to the company. It raised its share value, but it's gotten some companies into trouble these days, like the airline companies in the US. So whenever an expert says that the company has a rock solid balance sheet, they have low debt. I mentioned this, utilities build infrastructure, so they tend to have high debt. Same with REITs, real estate investment trusts. They bought those office buildings and those warehouses with borrowed money, so they'll also tend to have high debt. Not always, but a lot of the time. Current ratio, short-term assets divided by the short-term, which I said 90 days accounts payable. Yeah, anything?
looks like we lost Alex.
I'm sorry? All right, well, moving on. So the the current ratio should ideally be 2 or more, meaning you have twice as many liquid assets compared to your current liabilities. Um, if it's if it's less than 1, then that means that if all the creditors came asking for their money, the company could possibly go bankrupt. So I'd try to avoid these. Um, Creditors tend not to try to bankrupt the company because then it's likely that they won't get all of their money or any of their money. Price to sales, price per share divided by revenue per share. So that's the indicator of the um, of how much are you paying for a dollar of sales of the top line, the revenue, the income. So it's used by investors, as I mentioned, that earnings, the profits can be brought up artificially and temporarily by cutting expenses, but the revenue isn't fully under the company's control. So it's a little bit more. It gives you a truer idea of the company. Return on equity, I think this is the last one. So it's the earnings divided by the equity, meaning assets minus liability. It's a measure of effectiveness of the management and how they allocate the company's capital, i.e. the equity, and then how they make money off of the equity. So what you would like is for that to be better than 20%. Okay,